This is the United States economy in the opening months of 2026. The title of our story is not a prediction. It is a diagnosis: 2026 economic collapse. How 38 trillion in debt and Trump's tariffs could break the US economy. The numbers are so vast they lose all meaning. So let's give them meaning. The US national debt has just pierced the $38 trillion ceiling. To understand that, picture this. If you spent $1 million every single day, it would take you over 104,000 years to burn through $38 trillion. It is a sum greater than the entire economic output of the nation for a year, and it is not static. It is a runaway train, accelerating by $2.4 trillion more. Every single year, that's an additional $6.5 billion of debt every day. This is the crack in the foundation. Enter the new president, Donald Trump, with a sledgehammer, promising not to repair the crack, but to build a new penthouse on top of it. His solution? An economic doctrine of aggressive universal tariffs. A 60% wall on Chinese goods, 25% on neighbors Mexico and Canada, and a 10% baseline tax on nearly everything else the US imports. The promise is seductive. These tariffs will be so lucrative. They will generate a 2,000 tariff dividend for every American family and even begin to pay down that monstrous 38 trillion debt. It is a promise that feels good. It sounds strong, and mathematically, it is a fantasy of catastrophic proportions. Let us do the math that no one in the euphoric stock market seems to want to do. The US imports about $3.4 trillion in goods annually. Even if we take Trump's proposed tariff rates at face value and assume no change in consumer behavior, a heroic assumption, the theoretical maximum revenue is around $700 billion, but economics is not theoretical. Tariffs are a tax, and when you tax something, get less of it. As prices rise, demand falls. Companies scramble for more expensive, less efficient supply chains. Realistic estimates from economic models place the actual sustainable revenue at a far more modest $400 to $500 billion. Now, place that number against the $2.4 trillion annual deficit. The tariffs would cover, at best, 1/6 of the new debt we add each year. They do not even begin to touch the principal of the $38 trillion mountain. Then subtract the promised $2,000 dividend for 130 million households, a $260 billion annual cost. Suddenly, that for $0.0500 billion in revenue is slashed in half, leaving a paltry $1.0240 billion for deficit reduction, a drop in a $2.4 trillion bucket, a rounding error in the nation's ledger. But the real damage isn't in the failed arithmetic. It's in the chain reaction it ignites. Tariffs are not paid by foreign countries. They are paid by American companies, and ultimately, you, the American consumer. The price of everything from electronics and clothing to cars and groceries spikes. This is inflation on steroids, hitting an economy that just recently wrestled the inflation genie back into its bottle. Meanwhile, Wall Street is throwing a party at the top of our shaky skyscraper. The S&P 500 is at a breathtaking 6,640, hitting all-time highs daily. Bitcoin is flirting with $100,000. Gold has surged. The narrative is one of untrammeled optimism. Major banks like Barclays and Morgan Stanley are publicly projecting the S&P to rocket to 7,400, even 7,800 by the end of 2026. They are betting on the other parts of the Trump agenda: massive corporate tax cuts, a bonfire of regulations, and an explosion in corporate profits. They are listening to the music, not the engineer's report on the foundation. They see the sledgehammer of tariffs as a tool of negotiation, not a weapon of economic self-destruction. They are wrong. This disconnect between financial euphoria and fiscal reality is the kind of dissonance that has preceded every great financial collapse in history. It's the sound of the orchestra playing on as the Titanic took on water. The foundation is cracking. The architect is swinging a sledgehammer, and the party on the top floor is getting louder. But the laws of physics and mathematics are immutable. They cannot be voted out, wished away, or silenced by a bullish market report. But what happens next will change everything. The initial rally will be spectacular, a final, blinding flash of optimism that will convince everyone the good times are back for good. What follows, however, is a sequence of events so predictable, so mechanical, that we can map out the collapse step by step. The dominoes begin to fall. The first act of this tragedy is not a crash, but a crescendo. In the first quarter of 2026, the new administration moves swiftly. The tariffs are announced, and the market, initially jittery, quickly interprets this as a show of strength. The simultaneous promises of corporate tax cuts and deregulation drown out the warning bells. CEO confidence surges, animal spirits, that fickle driver of markets, take over. The S&P 500, instead of falling, powers upward, breaching 7,200. Bitcoin becomes a global sensation, smashing through $100,000 and racing toward $120,000. Financial media headlines proclaim a new economic dawn. The feeling is infectious. It feels like genius. This is the seductive lure of the bubble. It doesn't pop because people are stupid. It pops because the story is so compelling that the smart money rides the wave, all the while quietly moving their chairs closer to the exit. The first domino teeters in the spring of 2026. It's called retaliation. China does not absorb the tariffs. It responds in kind. Beijing strategically targets American agricultural exports, soybeans, corn, pork hitting the heartland. Then it moves to manufactured goods and Boeing aircraft. Suddenly, the very farmers who formed a core part of the political base are watching their markets evaporate. Mexico and Canada, key partners in the USMCA trade bloc, enact their own counter-tariffs, disrupting the tightly integrated North American supply chain. The cost of building a car in Michigan soars because the parts from Ontario are now 25% more expensive. This is the moment the economic story shifts from one of growth to one of contraction. The first corporate earnings reports of the year come in. Revenues are flatlining as exports stall, but costs are visibly rising due to tariff-inflated supply chains. Profit margins, the sacred cow of Wall Street, begin to compress. Companies issue cautious, then pessimistic, guidance for the quarters ahead. Simultaneously, a silent crisis brews in the bond market. For decades, US Treasury bonds have been the bedrock of the global financial system, the ultimate safe haven asset. The world has loaned America money because it was the safest bet on earth. But now, key foreign lenders, like China, begin to slow their purchases. Why would they finance the debt of a nation that is actively making trade? With it more expensive? China's treasury holdings begin a steady drip-drip decline from $770 billion. This is not a panic sell. It's a strategic retreat. The consequence is simple and brutal. When demand for US debt falls, the interest rate the government must pay to attract buyers rises. The yield on the 10-year Treasury note, the benchmark for everything from mortgages to corporate loans, begins a relentless climb. It ticks past 5%, then 5.5%. The market, which had been betting on Federal Reserve rate cuts, is caught completely off guard. The second domino falls. The credit squeeze, mortgage rates, which had briefly dipped, rocket back above 7%, freezing the housing market. Corporations, facing higher borrowing costs and lower profits, halt expansion plans and layoffs begin. The S&P 500, realizing the perfect scenario is broken, undergoes a violent correction. It plunges from its 7,200 peak to 6,200, a 14% drop. Bitcoin, the poster child of speculative excess, is hit even harder, tumbling from $120,000 to $90,000. This is the healthy correction. The buying opportunity the talking heads on television will urge you to embrace. But for those who understand the mechanics, this is not a dip. This is the first tremor of the earthquake. The foundation is groaning under the combined weight of a trade war-induced slowdown and spiraling borrowing costs. The Federal Reserve is now trapped in an impossible dilemma. Cut rates to stimulate the economy and fuel the inflation fire, or raise rates to fight inflation and accelerate the recession. They are in a box canyon, and the walls are closing in. And this is where the video takes a shocking turn. Because the next domino to fall won't be a trade policy or an interest rate. It will be a single catastrophic failure in the financial system itself. A spark that ignites the tinderbox of leverage and fear that has been building for years. The cascade of fear. Every financial collapse needs a trigger. A Lehman Brothers moment that transforms worry into outright panic. In our timeline, that moment arrives in the third quarter of 2026. It doesn't matter what the specific trigger is. It could be a major regional bank, overexposed to crumbling commercial real estate loans, announcing catastrophic losses. It could be a highly leveraged hedge fund blowing up on wrong-way bets on interest rates. It could be a corporate behemoth failing to roll over its debt. The specific name is irrelevant. What matters is the signal. It ends. The system is breaking. This is when psychology takes over from economics. The word contagion re-enters the lexicon. The initial failure triggers margin calls across the leveraged financial world. Hedge funds and institutional investors who borrowed cheap money to amplify their bets are now forced to sell assets to cover their losses. But they don't just sell the bad assets. They sell everything. High-quality stocks, bonds, gold, Bitcoin, it all gets dumped into a market with rapidly disappearing buyers. This is a liquidity crisis. The exits are too small, and everyone is trying to get out at once. Algorithmic trading systems, programmed to detect momentum and volatility, amplify the selling into a freefall. The S&P 500 doesn't just decline, it collapses. It crashes from 6,200 to 5,200 in a matter of weeks. The VIX volatility index, the so-called fear gauge, explodes above 50. Trading is halted repeatedly by market-wide circuit breakers, but these pauses only heighten the sense of dread. The feeling of control vanishes. Bitcoin, the uninsured, highly volatile asset, is eviscerated. Its 80% drawdown, a feature of every prior crypto winter, arrives with a vengeance. It plummets from $90,000 to $55,000, then continues its harrowing descent. The narrative of digital gold shatters. In a panic, it behaves as pure, leveraged risk. The Federal Reserve holds an emergency meeting, but unlike 2008 or 2020, their hands are tied. Inflation, stoked by the tariffs, is still running hot at 3.4. They cannot simply slash rates to zero without unleashing hyperinflation. Instead, they announce complex liquidity facilities to backstop banks, a technocratic solution that does nothing to calm the sheer terror on Main Street or in the corporate boardroom. By the fourth quarter of 2026, the crisis moves from Wall Street to Main Street. The economic data becomes undeniably grim. The economy has officially entered a recession, with 2 consecutive quarters of negative GDP growth. Unemployment, which was at a generational low, leaps from 4% to 6%. Millions of families who had been living paycheck to paycheck in the everything-is-fine economy are suddenly facing the abyss. Layoff announcements become a daily drumbeat. Consumer confidence shatters. People stop spending on anything non-essential. Retail sales plummet. The very tax revenues the government relies on to function income. Taxes, corporate taxes, sales taxes begin to dry up. And here, the death spiral of the debt accelerates. The annual deficit, already a horrifying $2.4 trillion, balloons to over $3 trillion as revenues collapse and automatic spending on unemployment benefits surges. The national debt smashes through $41 trillion. The government is now forced to borrow this massive new debt at punishingly high interest rates of 6% or more. The trillion-dollar annual interest payment becomes a $1.2 trillion anchor, dragging the entire ship deeper into the abyss. We are no longer talking about a stock market crash. We are witnessing the first stages of a sovereign debt crisis. Most people never hear the next part, and that's the real danger. Because when the world loses faith not just in American companies, but in the US government's ability to pay its bills, the entire global financial order begins to unravel. This is when the unthinkable becomes reality. The aftermath and a new world order. The final act begins not with a bang, but with a failed auction. In early 2027, the U.S. Treasury Department holds one of its regular auctions to sell new government bonds. But for the first time in living memory, there are not enough buyers. The world's central banks, from Beijing to Riyadh, are diversifying furiously into other currencies and gold. Domestic pension funds are tapped out. The auction fails. The message is sent. The market is questioning the creditworthiness of the United States of America. This is the point of no return. In a state of panic, the Federal Reserve is forced to become the buyer of last resort in a way it never has before. It announces unlimited quantitative easing QE. Effectively, it turns on the printing presses to buy the debt that no one else will. This action stabilizes the bond market temporarily, but it assassinates the value of the US dollar. The dollar index, which measures the greenback against other major currencies, collapses. A 10%, then a 20% devaluation unfolds in months. For Americans, this means the cost of every imported good from oil and pharmaceuticals to the components in your phone skyrockets. Inflation, which had briefly receded during the recession, roars back to life at 6% or higher. This is stagflation, a stagnant economy combined with raging inflation, the economic nightmare every policymaker fears most. In this storm, the stock market finds its brutal bottom. The S&P 500, having already been cut in half, grinds down to a soul-crushing 3,400. This represents a 49% loss from its euphoric peak. Retirement accounts are decimated. Bitcoin, the ultimate speculative bubble, completes its collapse, bottoming near 19000, an 84% wipeout that destroys the life savings of countless retail believers. But the true winner in this chaos reveals itself: gold. After an initial dip during the forced liquidations, it begins a relentless climb. It is not a speculative asset. It is a store of value that carries no counterparty risk. It doesn't care about corporate earnings or government promises. As the Fed prints money and the dollar withers, gold surges past $4,500 an ounce, a safe harbor in a world of failing paper assets. The human cost is incalculable. Unemployment peaks at 9%. Real people, the recently graduated, the factory worker, the middle manager, face a depression-like reality. Homes are foreclosed upon, cars are repossessed, small businesses, the backbone of communities, shutter forever. The social fabric strains under the weight of widespread economic despair. The political center evaporates, replaced by anger and extremism. The United States emerges from this fire forever changed. The national debt stands at $43 trillion, a monument to past profligacy. Interest payments now consume 30% of all federal tax revenue, cannibalizing the budgets for defense, infrastructure, and education. The nation's pristine AAA credit rating is stripped away, a symbolic fall from grace. The US dollar, while still important, has lost its unassailable status as the world's sole reserve currency. Other nations, having witnessed the fragility, accelerate their plans for a multi-currency world. This is the legacy, not of a single policy or a single president, but of a nation that refused to heed the mathematical truth. The $38 trillion debt was not an abstraction. The tariffs were not a magic wand. They were a sledgehammer taken to a structure that was already compromised. The story of the 2026 to 2027 collapse is a timeless one. It is a story about the seductive power of simple solutions to complex problems. It is a story about the dangerous disconnect between financial markets and economic reality. And most of all, it is a cautionary tale about the immutable laws of mathematics. which, in the end, always have the final say. The party at the top of the skyscraper is over. The music has stopped, and all that remains is the long, hard task of rebuilding from the rubble.